If anyone's spent some time looking at portfolio construction conferences or reading investment commentaries over the recent years, they'll come across this concept of risk budgeting or risk parity. And to a degree, what the concept is pointing to is that if you look at a client's capital allocation or asset allocation, at say 40 or 50% of their capital allocated to say listed equities, about 90% of the risk in a portfolio is coming from that capital spend of 40 or 50%. A disproportionate contribution of risk from a smaller part of a client's capital. And that in itself has not necessarily been a bad thing. In fact, it's been a really good risk for investors in Australia to own, given we've had the best performing developed stock market. But it's a risk that we should be aware of, and for some of our clients it might be a risk that we need to address. It doesn't say, as some people might interpret it, that we own too much equity or that we should have less equity in a portfolio, but what it does say is we need to be aware of the types of equities that we own and the characteristics that they bring to a portfolio, and really importantly the prices that we acquire those equities at. Given the biggest risk that we can all agree in our portfolios is driven by listed equities, it makes sense to look at ways that we can reduce that risk. And there are a couple of ways. They're not necessarily complete solutions in themselves, but in some regards, using them goes to mitigate some of those risks. And I think one of the tools that we have at our disposal is what I would call investment mandates. I think it's fair to say, and many commentators can say it better than me, that our Australian equity market is increasingly concentrated by a handful of stocks and a handful of sectors for that matter. And I think in a market that is so concentrated, what we should be encouraging is more flexible investment mandates. Genuine investment managers that have the discretion not only to own stocks that they wish to participate in, but also potentially sell stocks that they may wish to profit from. So I think the emergence of more flexible investment mandates, whether it is concentrated equity portfolios, long-short equity portfolios, portfolios that are focused on particular areas of the Australian equity market that give investment managers discretion, not necessarily benchmark aware strategies, but strategies that are much more orientated towards our clients' outcomes, is one of the tools that we can use to reduce risk. I think another tool that's often forgotten when thinking about Australian equities is the tool that I would call investment style. That is the way that a particular investment manager may approach building their portfolios. And given in such that we're trying to reduce the risk of a portfolio, what we're looking for is an investment style that tends to produce outcomes that are lowly correlated with the market outcome. I think another way of saying that, we're looking for investment managers that outperform when markets fall. Alpha that is lowly or negatively correlated with market beta. And one of those styles is called value. And at Perpetual we've got a very disciplined investment style, and it's referred to as quality and value. And inherently, if you think about it and you acquire good businesses, good quality businesses, and you acquire those good quality businesses at good levels of valuation, you have got some downside protection. And for mine, that's one of the ways you can think about lowering risk. Investors can buy cheaper ways of getting market exposure. They can buy things like index exposures. But an index won't ever provide you any down market protection. It won't provide you any up market protection. It's not designed to. It's designed to provide you the index. And so if as a fiduciary, if as an investment manager you're trying to reduce risk in your portfolios, particularly your Australian equity portfolios, looking for an investment style that provides some level of risk reduction makes sense. And for mine, those two tools in combination are more powerful in combination than either of them in isolation.